Good evening. Welcome to this very special edition of the India Development Debate. I am Tamanna Inamdar. Two very important numbers today have dominated headlines all day and give us a picture of the economy. The first number is 5 and the other is 12. At 5% GDP clocked for the first quarter of this financial year, India has seen the lowest growth figures in 6 years, over 25 quarters. But on the same day that this dismal and worrying figure has emerged, even lesser than what was expected, the government has made a major effort to restructure the public sector banking system. Which brings me to the other number, 12. That's the number of public sector banks we now effectively have in the country, down from 27. Never since the nationalization of banks have we seen such a big move in the Indian banking space. The finance minister made this announcement in a press conference, which is the second one in that series of reforms conferences that she started a week ago. Listen in.
So what is it that you're going to have? The anchor bank will be Punjab National Bank in the first merger that I announced, where the amalgamating banks are Oriental Bank of Commerce, United Bank of India. Business size is 17.94 lakhs. PSB rank by size would be second, and the particular computer networking, fintech networking is Finacle. Similar, Canara Bank and Syndicate Bank coming together gives us a bank size of 15.2 lakh crores, becoming the fourth largest. iFlex is the system that they use. Union Bank of India, together with Andhra Bank and Corporation Bank, will become the fifth largest of the banks, public sector banks, with 14.59 lakh crores for their business size. Then Indian Bank with Allahabad Bank reaches the business size of 8.08 lakh crores, will be the seventh largest bank.
Okay, so there's bad news and there's good news. The bad news is that the slowdown is perhaps worse than anticipated. The good news is the government of the day looks like it wants to do something about it. The big question is, where are we in this slowdown cycle? Are we near the end of the drop? And how far will the measures announced by the government go towards a speedy recovery? Speaking to me today on this now are D.K. Joshi, Director and Chief Economist at CRISIL, Dr. Rajat Kathuria, Director at ICRIER, Dr. R. Nagarajan, Professor at IGIDR, Anant Narayan, Professor at SPJIMR, R. Jagannathan, Editorial Director at Swaraj Magazine, and Maithili Bhusramat, Consulting Editor at ET Now. Welcome to all of you and thank you for joining us today. Mr. Kathuria, let me begin by asking your opening views. And for the first half of the show, we're speaking about the public sector bank merger and the big moves over there. So your thoughts on how this will really make a difference, because the important part is, along with the actual merger and reduction of 10 banks to essentially 4, there has also been an announcement on a lot of HR measures, I would say, in the way the board would run, in the way appointments would be made. Do you think that those are important points, considering that no jobs are being cut?
So I think the latter is the more important measure for me. So the merger of the banks, the consolidation rather of the banks, is a good idea, and it will improve efficiencies, and I hope that no jobs are lost. Over time, I guess there will be some churning and there will be some efficiencies that will be created in the system, and I think there will be some risk pooling that will happen. So that's the good part. And the other sort of good part of the announcement is the HR measures, and I think that's much more important. And the reason I say that is because public sector banks have been languishing in the sense that their decision making, often people say, is not independent enough. And there was, if you remember, many years ago, I don't remember the exact year, there was a PJ Nayak committee report that had come out,
yes,
which had talked about sort of precisely the corporate governance sort of reforms that need to be made in the public sector banks. And I think if you look at that report, you will see that these are the measures that were suggested in that report. I think we need to have corporate governance reform in the public sector banks. The moment you sort of isolate or reduce the political decision making in public sector banks on projects, I think there will be a turnaround. It might take a little bit of time, and I'm hopeful that this will happen, and this could be the first step towards getting there. I mean, consolidation is probably a step, if you look at it as a stock move, but the flow in the sense where the decision making, everyday decision making needs to be made. I think where if we get independent decision making, directors who are making decisions, boards that are making decisions on their own, I think that will be a huge bonus or a huge step in the right direction for the public sector banks.
Okay, let me come to Anant Narayan to get your take on this big change we're seeing. It's something that was spoken about for a long time, Anant. But there are mixed views that I've been seeing out there on the decision not to, remove any employees or reduce the number of employees among these banks. Of course, politically speaking, it is a very important decision because without that, I don't think the government would be able to even take this forward. But from a business perspective, there will be overlaps in departments, in branches. Would there then be efficiencies if there are no jobs removed?
Good evening, Tamanna, and absolutely. Look, I completely agree with what Mr. Kathuria just said. I think he put it well. I'll put it this way. The good thing, as you mentioned, is that the intent seems to be there right now. If every Friday evening we're going to get a series of announcements from the finance minister, I think we can all enjoy good weekends going forward. But at least there is an acknowledgement that there is a problem, and the later half we will discuss GDP numbers, and that will probably reinforce that particular part. Now, the way I see it is there are lots of areas of the economy which have serious core issues which need to be addressed, and banking is one of them. Now, as you rightly mentioned, it's not just about consolidation. It's great to have 12 banks rather than 22 banks or whatever, but it shouldn't stop there. We're talking about much deeper reforms, which unfortunately will be tougher to conduct. The starting point of that reform is to make bank managements more autonomous, to increase the distance between North Block and bank management, to have more accountability and freedom on bank management. That is required, and that's exactly what the PGNI committee recommendations tried to cover. The consolidation is all very well, but we shouldn't mistake banking reforms only with consolidation. There are plenty of other things to be done. Two things I would point out. One is solution to the NPA issue. Yes, NPAs are coming down, but there is more to be recognized, and the resolution is painfully slow. We need a long-term solution around that.
Yeah.
Second, as Mr. Kuria was saying, broader governance reform along the lines of PGNI committee recommendations,
Yes,
which are going to be painful. Essentially, you're asking Delhi to give up control of banks in some form. This is not privatization. This is autonomy for banks, and that unfortunately hasn't happened so far. Hopefully, it will happen.
Okay, will Delhi give up control of banks? Will remain, something we'll have to wait and watch and how that's really done. So the intent is there. The implementation will matter. I want to get Maithili in on, your take on the banking reforms, so to speak. It's a bold move, Maithili. Let's begin from there. You'll have to admit it's a bold move, one which is being talked about for a long time. Is it the need of the hour right now, or is it also a message that we're ready to take these big moves, we're ready to do something about the situation right now?
Tamanna, a bold move need not necessarily be a good move. You could have a bold move which is not well thought through, and you can have a bold move which is a very good move. So my take on this really is that it's a bold move which serves no purpose at all. In fact, the cost could be huge, could be enduring, whereas the benefits are very, very questionable. In fact, this, if I were to put it very, pithily, is basically the triumph of hope over experience. Wherever we have gone in for these kind of shotgun marriages between public sector banks, taking them virtually for granted, taking the consent of the boards virtually for granted, I think it is a very negation of all that the reform process stood for. The reform process was really about distancing government from public sector banks, allowing them to function as commercial entities. But what we saw today was exactly the opposite. Government has decided who will get married to whom, and the boards will dutifully sign on the dotted line. This is not what reform was supposed to be about. If the government is serious about public sector reform, what they should have done is reduce the stake, government stake in public sector banks, gone through with the PGNI recommendations, which are excellent recommendations. In fact, Anand says that this is the beginning, that consolidation is part, it should not be the end of reform. In fact, I think consolidation is perhaps the least important part of reform. Much, much more critical reforms remain to be done, and things like a 59-minute loan for MSMEs. How can you have a commercial entity which gives you a loan in 59 minutes? Excuse me, that is not how banks work. That's how government departments can perhaps work, but not when you're parting with public money. So I think this stands for the very negation of everything that reform stood for. If no government had acted on it for 20 years, it was for very good, valid reasons. I'm afraid I'm very disappointed with what has been done today. It is not what reforms are supposed to be about.
Okay, I want to get reactions to that statement from Maithili. I'm going to come to you, Mr. Joshi. Do you want to comment on the point that Maithili is making? Because there is one view that this is giving more autonomy to the banks. That's in fact what the finance minister said. That, and one part of it is them being able to hire chief risk officers from outside at market salaries, etc. Your take on that, Mr. Joshi? Is it distancing, or is it, like Maithili put it, the government telling who to get married to whom?
Well, I think when I'm not the banking specialist from CRISIL, I mean the other spokesperson, but I can just, say that this step that was taken today opens up, I think it's not that it's negative completely. I think it opens up possibilities of reaping in economies of scale. I think operating efficiencies can go up. And also I think the business synergies can be exploited much better, provided I think the other reforms which people are talking about are also put in place. I think then you will get the full benefit of these reforms.
Okay, Professor Nagraj, do you want to come in on, first your view on the consolidation of public sector banks, again something which is being spoken about for very long. The fact that the finance minister made it clear that it's not in a vacuum. There has been last week 70,000 crore rupees recapitalization plan. So far the plan seems to be recapitalize, consolidate and professionalize. In itself, do you think it will go a long way in making public sector banks, essentially government owned banks, more competitive?
Yeah, thank you. I think this is a correct move, considering that public sector banks have stagnated in size for a long time. So, considering the global experience, where you have large banks globally, every major economy of the world is dominated by large banks. There seems to be economies of scale in banking operations. If that is true, then I think it makes sense to consolidate public sector banks. As you rightly reminded, last week the finance minister took a decision to infuse fresh capital from the government into the banks, and this is a second step. I think this is a good move, considering the global experience of having large banks. But more importantly is that there has to be greater autonomy and greater managerial freedom. I agree, autonomy and accountability are two sides of the same coin of corporate governance in a public sector.
Yeah.
But I think the public sector banks often suffer from excessive control from the government, and also they are often made to pay for all public policy concerns. Just imagine the Jan Dhan account, which is a great move, a right move from a public policy point of view. Yeah. But this was an enormous additional burden for the public sector banks, whose costs have not been reimbursed to the banks, and which are whereas the private sector banks can get away without it. So therefore, because of many public policy considerations, the public sector banks have to incur enormous additional costs. So unless they are given greater freedom about it, or they are adequately compensated for it, public sector banks will not be able to perform as well as other banks. So I think not just consolidation, not just infusion of money. What is important is that there is a greater managerial autonomy. I think which is a must. But there is a macroeconomic factor which one should not forget. Unless there is a growth in the economy, the NPAs will not get dissolved.
Yeah.
We must understand, in a slow economy, when the credit growth is not happening, okay, when the economy is not happening, when the denominator is not growing, the NPAs will continue to grow as a percentage of total credit. Okay. Therefore, I think for the NPA issue, it is not just a question of bad practices or bad management, but one must also keep in mind the economy not doing well, which is affecting the bank's performance. So just attributing the poor performance only to the management would also be inadequate. I think one must keep in mind the larger macroeconomic considerations in bank's performance.
No, absolutely, absolutely, and we're going to come in the latter half of the show, as I said, in a bit more detail on the dismal GDP figures that we've seen. And you put it rightly, Dr. Nagaraj, that how the two are linked. Let me come to R. Jagannathan. And one question which has come from the discussion so far, more autonomy is being promised, consolidation is being promised, there may be efficiencies of scale, but as long as public sector banks remain at the fulcrum of government policy, as they have been at the center of every major scheme pretty much that this government has rolled out. Will it really make a difference then beyond a point, whether it's 10, 4, 27 or 12?
Absolutely not. I think we have to see this in two ways. One is in terms of the pace of change in the earlier years after 1991. This pace under this government is quickening. But it is not substantially moving the needle for two reasons. Because public sector banks do not operate in a vacuum. They are up against the private sector, which is far more agile. So it is the pace and the rate of change that is going to make a difference to whether you succeed or not. So if the private sector banks are going to grow at a phenomenal rate, they're going to digitize and they're going to get out of branches, ATMs, cards, everything, and move to entire mobile phase. And these fellows are still talking about consolidation and scale and all that, when focus and customer is more important than just size. I think these fellows are going to lose the thing. The point is, the biggest failure of government banking policy is the failure of the Modi government to say the P word. If you do not privatize, it's okay to have 5, 6 banks which you want for your own public policy purposes, but the remaining banks need to be privatized, shut down, narrowed down, whatever else you have to do. They will become white elephants, because as I said, it is the rate of change that makes a difference to success or failure, not the scale alone. And in 5 years, I think some private bankers expect public sector to shrink to 50%. So no matter what your scale, your size of businesses relative to the cake is going to go down. So I think till you start making focus and customer orientation and pace of change the key determinants in public sector banking, they are going to lose the war. And they are already losing the war. So I think all this is okay in terms of, if you compare private sector pace of change with what is happening in the past. I think all this consolidation is good, because what Narasimham talked about in 1991, you have achieved in 2019, 28 years later. So what is the big deal? So if you take 28 years to implement a policy that was announced in 1991, how are you going to make any big change, especially if you have CVC and CBI jumping down your throats? So I think nothing is going to change. It is just incrementalism, change for the sake of change. It will not move the needle in terms of public sector competitiveness vis-a-vis the real challenge that they are going to face.
Okay, let me open this up to responses and open up the debate now that everyone has given their primary comments. So if you want to come in with a point, please indicate and I will come to you. But I will first go before that to Mr. Kathuria, because you started off the round of comments and you've heard what everyone has to say. You began by saying this is an excellent move. And then there have been points of view saying that it doesn't really move the needle. You want to come back on that, sir?
No, so I think, as I said, it's the first step. This is there's fragmentation of the banking system, and a banking system which is large reaps the benefit of efficiencies and economies of scale, and there could be risk pooling. So that's the benefit. Although it should have happened much earlier, I agree completely, it should have happened much earlier. And there's another debate on whether there should be such public sector banks anywhere in the first place, and whether we should privatize them. I think the financial sector privatization will come last, because public sector banks have been, instruments of public policy,
Yeah.
and they've used them as instruments of public policy. So how do you get these banks to work better? How do you get, given that, I'm not a supporter, but I'm saying that how do you get these banks to work better? And some of the points are you get, lateral entry, get chief risk officers, get experience from the private sector, and get them to operate. So that says some change in the working culture of the environment working culture within the banking system. The other thing I think everybody has agreed and everybody emphasizes is the fact that you do need to change the way the bank boards function. The corporate governance of banks is extremely critical. And if autonomy is given to them, there is no reason why the public sector banks will not be able to compete with the private sector banks, although I think the public sector banks are encumbered a lot more, and as I said, they're used as instruments of public policy, and they will continue to be used as instruments of public policy. I don't think we should even think about the fact that the banks are going to be relieved of the public policy role that the government might impose on them. But the good news, I mean,
let me
look at
just
it
spin
as...
that argument, Mr. Kathuria. Why should they be relieved? Who's going to do it then? Who's going to do it then? Who is going to be the instrument of public policy, which is part of the government's mandate?
The government is going to do it because nobody else can do it. The government has to do it. And when can the government do it? The government can do it at a time when there is a crisis. And I think we are in the middle of the crisis, and there is no better time to reform, or at least take this in first steps towards reform, than in a crisis. We've seen 91, we had major reform when there was a crisis. I think there is a crisis now, and we have recognized that there is a crisis, and we are taking steps. Some of the steps, as you will talk about in the program in the latter half, some of the steps may be successful, some of the steps may not be successful. But I think the good news that Anant also, I think, echoed, the good news is that there is a recognition there is a problem, and there is an intent to begin to make that change. Whether that change will be successful, of course, depends on the implementation. As we say in India, what are the three things that you would not want to do in India to improve the economy? It is always implementation, implementation, implementation. There's so much slip between the cup and the lip, but at least, okay, I mean, give the government its due. They've started the process. Now it depends on how they are going to follow through.
Okay, Anand, you want to comment on some of the points made? Should we look at this first step and the fact that there is a will to make a big move as a mega positive, hope for more to come, and what else would you like to see to really make this plan to consolidate public sector banks effective?
Well, yes, Tamanna. I think sadly, everybody seems to be agreeing with everybody, so it's a kind of an uninteresting debate in that sense. We all seem to agree that that there is more to be done in terms of reform beyond just consolidation. I'm waiting for Maitri to violently disagree with me now.
Okay.
Here is a roadmap which I think works. PJ Naik committee, I think a lot of us mentioned. Jaggi sir's point about privatization is, let's face it, it's not an easy step to take. It's very controversial, and there are multiple thoughts on that. But the PJ Naik committee talks about, let's start by putting a distance between the government and the banks. I hate comparisons with other countries, but look at Singapore. You have DBS, which is largely government owned, but not under direct control of the government. You have Temasek, a sovereign wealth fund, which owns the banks. So similarly, the PJ Naik committee had talked about opening a CIC, an investment corporation, which would hold the shares on behalf of the government, building in a distance, therefore addressing many of the issues raised earlier, which is get the banks under Companies Act, get them out of CVC, CBI, ED, and so on and so forth, make it on par with other private sector banks, and then allow, why is it that only CROs, risk officers, should be given market-linked salaries? Why not the CEOs? Why not the people actually on the front line and in the back end managing the bank's risks? Now, for doing that, you have to bring those banks under an autonomous, Companies Act kind of a framework, rather than a public sector framework. So there are multiple steps which have been listed out in the PJ Naik committee report. By the way, our chief economic advisor was a member of that committee. Maybe this is a great time, given that there is a bit of a crisis environment around, for us to dust off that report from 5 years ago, not wait for 28 more years, as Jaggi was saying, and actually start to implement some of these, at least debate as to whether this is the right way forward. If there are more tweaks required, let's do it. But structural changes in the nature of banking, getting away from phone banking, getting away from influenced North Block banking, I think is very, very important. putting autonomy and giving accountability to the bankers, I think is super important. PJ Naik committee gives us a roadmap. It's time to debate that and dust it off.
Okay, Maithili, since Anand has passed the baton to you and is waiting for you to, as I quote him, violently disagree, would you like to take the bait?
Oh yes. Oh yes, of course. In fact, Anand made the mistake of saying that everybody agrees. I'm sorry, I don't agree. I might be in a minority, and in fact, there's almost nobody on my side, completely isolated on this. But I think the entire consolidation process is a complete sham reform. It is not a reform at all, because it doesn't do anything to alter the state of public sector banks in the country. If at a press conference the finance minister has to announce that the number of members in a consortium, she has to even say how many members there should be in a consortium, that should be a commercial decision left to the banks. Now, why do we have a situation where the finance minister has to say how many members should be there in the consortium, what is the kind of CASA targets people should have, a 59-minute MSME loan? I mean, this is not a government department. I think we need to be very clear, are public sector banks, are they banks? Or are they something else? When I joined the banking sector in the mid-70s, there was no dispute at all. Banks, public sector banks were virtually an extension of the finance ministry. I'm afraid, unfortunately, today we seem to have gone back to that situation. So this is not reform at all as I see it. In fact, I think it's a very retrograde step. Unfortunately, under the pretense of reform, what we have done is done far more damage to the state of public sector banks, because it has been a government mandated shotgun marriage. All the banks dutifully, who have been selected, the boards will go back and dutifully sign on the dotted line and come back. What kind of a merger is this? Mergers are normally driven by the boards, where they see commercial viability, not like this. So I'm afraid this is a very sorry commentary on a supposedly reformist government, where we go back to something that even Mrs. Gandhi perhaps would have been subsequently ashamed of.
Yeah, so then how else could this have happened? I want to get more views in. Jaggi, you want to come in on that? How else could this have happened? I find that term very interesting, a shotgun wedding, sort of a arranged marriage in the Indian context, but does it really work? Do parents know best in this case?
Yeah, I think in a public sector culture, I think the culture differences are not too many.
Yeah.
So, I may worry about some of the 4 mergers announced. Maybe that the Allahabad Bank, Indian Bank might not be so merger-wise connected. It's a north-south marriage, which is something that might take some time to work. But the rest of the things will probably work. I think the BOB one has worked fairly well. I think the State Bank internal culture things have worked very well. I don't see a culture thing being a major problem in the short run. But what I feel is that since it will take 2 years to sort out these culture issues, what you're going to get is actually a slowdown because of consolidation, because people will be internally focused in terms of how to fix this thing, how to rationalize branches, how to rationalize people, how to do these things. So instead of, so the big capital infusion will not go into credit, because the bank managements will be focused on internal fixing of all their issues. So the consolidation is not going to help us in the short run. But yeah, in the long run, I think if you want to bring the public sector down to 6 banks, you're right there. You got 2 already done. You got 4 more done now. So the remaining 6 banks, ultimately you need to either privatize them or merge with them. So you have 6 banks. I think that's broadly the right direction as far as nationalized banking is concerned. But I don't think it's going to deliver in the short run. It'll take a while.
Okay, Mr. D.K. Joshi, you want to comment on some of the points that have been made so far? Maybe, and that's the sense I get from what is being said, maybe announcing this consolidation on the back of that 70,000 crore rupee infusion, and today the finance minister broke down broadly who's getting how much, may not have been the best timing. Like Jaggi argues that perhaps a lot of energy is going to go in actually making this consolidation happen.
Yeah, I don't have any specific comment on this. I think CRISIL is in the process of examining it. I think I don't have a ready-made comment.
Okay, no problem. Mr. Nagaraj, you want to come in on that?
Yeah, actually, I am not. I don't know about the management issues, but I can tell you something. There are public sector banks globally which function well. Okay, and there are private sector banks which are doing very poorly everywhere. So there is, it is not a simple public versus private argument. It's a question of managerial, it's a question of governance, and how good is the governance. Here I think public sectors suffer from excessive government intervention, and of course government has a right to intervene because they are the ultimate owners. So they have right to intervene, but question is what kind of a system exists to separate the management from the ownership issues. I mean, this is a classic problem of corporate governance anywhere. So I think we face the same issues. So I think this is a decision at the level of the highest level within the banks and the government, and they need to sort it out. What kind of a separation mechanism one develops is something which I would not be able to say, but I think there is enough expertise available from various expert reports which should be used to build on this. So one must not see it as basically issue of ownership. I think ownership, you can have good public sector institutions and very bad private sector institutions. So it is not a question of ownership, it is a question of management. And where you can have enormous variations. So I would say in terms of principle and in terms of comparative experience, I think there is nothing wrong in having large public sector banks if they can deliver. Okay, and there are as somebody mentioned, we have DBS in Singapore, which is a public sector bank which does very well, and there is something we can learn from some of those good experiences. I'll stop here. Thank you.
All right. Let me move to another very important part of the entire state of the economy story that we're discussing today, and that is, of course, the GDP figure that has come through, lower than most polls and expectations at 5%. In fact, before I move ahead, I just want to play out what the chief economic advisor said today shortly after those numbers got out.
The quarterly GDP estimates for the quarter ending June 2019 indicate that India's GDP growth, while still high, has shown some slowdown. The government is quite alive to the situation, especially global headwinds arising out of deceleration in the developed economies and Sino-American trade conflict has contributed to the slowdown. The underlying robustness of the Indian economy is borne out by low inflation, which must be emphasized.
Okay, let me come to Mr. Joshi on the GDP number. Now, most estimates were between 5.5 and 5.7, I would say broad range of what Q1 GDP would look like. We already knew there was a 5.8 figure in the last quarter of FY19. Are you surprised? Do you think this is the bottom of the cycle? Is there worse to come? How do you look at the number?
Well, I think it was indeed a surprise, and we were expecting around a little over 5.5%. And the surprise came particularly from private consumption, which went down very sharply. Well, I think if you look at the trends in private consumption, it has been the bulwark of the economy for the last couple of years, growing faster than the overall GDP growth. So it was a leading engine, and households were leveraging themselves to support their consumption. They were even dipping into their savings because private savings were coming down. So this very, very sharp slowdown in private consumption was what came as a surprise. I did expect it to slow down, but not so sharply. I think that's a big surprise element in this, and I think that how the private consumption behaves going ahead is very critical for investments to pick up, because we still have some excess capacities which can only be exhausted if private consumption maintains its momentum. So clearly, I think that is one part. The second worry, which I think which didn't surprise, but was expected to be weak, was the manufacturing sector, which grew at merely 0.6%. The exports, which were extremely weak, the imports also extremely weak. So external segment was not helping, as the chief economic advisor was also pointing out. And along with that, I think the domestic disturbance in the financial sector intensified that even further. So clearly, I think manufacturing slowdown coupled with a sharp slowdown in private consumption, I think that these are the two main worries at this juncture. Going ahead, I think if I look into the rest of the fiscal year, it's not that nothing is supportive of growth. I would say that the monsoons, which are normal, should help, I think, agriculture grow above the trend this year. And on top of that, the oil prices are quite well behaved. I think that's a global tailwind for us because oil prices have actually come down over the last couple of months.
Right.
And then finally, monetary transmission, even though anemic, I think has started picking up. So I think overall, I think there are some drivers, but the downside, the headwinds are much, much stronger than the tailwinds.
Okay, so where are we in this cycle? Let me get a point of view from Mr. Kathuria on that. The efforts now have been to improve transmission. So like the finance minister said, 8 public sector banks have started that process as well by linking their rates to the PLR, etc. Do you see this as us heading towards the end or the bottom of the cycle? Essentially, do you think the worst is behind us, or do we need to prepare for more?
I think the absolute worst is probably behind us. Just like Mr. Joshi, I was expecting the numbers to be a little better, and the numbers are a bit of a surprise. But whether this bottoms out or not is, if you look at what the RBI said yesterday in its annual report, they see this as more of a cyclical than a structural problem.
Yeah.
And I would say that I think this is as much of a structural issue than if it was a cyclical issue, for instance, then your reduction in the interest rates and the fact that you've been trying to pump in money into the economy, and you've got all these public sector, social sector programs, then it should have seen a rebound as of now. But I think there is a need to sort of pump in more money, especially into the rural economy through innovative schemes. But I think we shouldn't lose sight of the structural problems that have come to sort of, if not to haunt us, at least to constrain our growth. And those structural problems, I would just mention it, and I'm sure there'll be a discussion on this, is that we've done a lot of product market reform, and that has sort of benefited us. There's a lot of competition in most of the sectors, in the real sectors. You see a lot of competition in at least the sectors that have opened up, automobiles, telecom, etc. You do see competition there, and that has benefited us. But I think now the next set of reforms, we have to reform the factor markets, and I think the factor markets are beginning to sort of show an effect on the long-term sustainability of growth. If we want to achieve a 5 trillion economy, we have to grow in nominal terms at over 12%. In real terms, we have to grow, close to 9 to 10%. And if we are not able to we won't be able to do that unless we have a recognition that there is a structural problem. So it's not merely that we need to improve our monetary policy and fiscal policy and do that. We need to also begin to now address the more difficult reforms, which is the labor market reform, which is the capital market. Capital market reform is ongoing, and I think those fruits will show. The land market and the labor market are 2 critical markets, I think, that we need to begin to show, and not much has been done in those 2 markets.
Okay, so what are the negatives? The negatives is that we've seen a 5% figure when expectations were between 5.5 to 5.7, so that's been a bit of a shocker. What are the positives? That we seem like we're willing to do something about it, and that there is the ability to take on these reforms that have been blocked in the past because of political compulsions, etc. At least mandate-wise, there seems to be no problem there. Anant, yesterday you were telling me that this whole structural versus cyclical debate, in your view, is pointless. But Mr. Kathuria makes an important point, that take this opportunity to do something about it. I'm also going to come to you with, I think, the big question that everyone, whether they understand economy or not, wants to know. Is the worst now behind us? Is 5% the lowest we are going, or are we in for some more painful times? By the way, before I come to you, Anand, and sorry if this question is getting long, but I just want to point out that Vivek Debroy has put out a statement, earlier this evening, and he's of course the chairman of the PMEAC, where he's predicting that H2, the second half, is going to get better. Do you see signs of that?
Well, Tamanna, if I could crystal ball gaze and figure out where we are headed, I wouldn't be here. I would be out making money in the markets. Look, the reason why I think the structural versus cyclical debate is pointless is because it gets into a blame game as to who's responsible for where we are right now. If we were to do a zero-based look at where we are and where we stand, ignore who's caused what. The issues I see in front of us are the following. The banking sector is hurt. We discussed this just now. NBFCs are in trouble, to put it mildly. The power sector is in trouble. Telecom is in trouble. Real estate and construction is in trouble. Airline and shipping is in trouble. All of these are core issues which require far more than just a stimulus and lower interest rates. These are structural issues which have to be addressed. So, we've known for a long time that the economy is hurting. While we focus on this GDP print for, far too much, I believe, we've always known these issues are dogging us and these need to be addressed. Second part, as Mr. Kathuria mentioned, why is manufacturing and export such a problem for us? And the reality is, again, at the bottom of the pyramid, we know that labor laws are easier in Bangladesh and Vietnam than in India. Land laws are easier in other countries than in India. So while we should be benefiting out of US-China trade wars, contrary to what the CA just said, and supply chain should be moving to India, on the contrary, we are actually seeing people moving out from India. So the need for both sectoral reforms in banking, NBFCs, power, real estate, and so on and so forth, and factor reforms is very, very important. So while we can give a stimulus, and I don't know how much room we have for further stimulus, the monetary policy is already fairly loose.
We have one more, hopefully Friday blockbuster left. The finance minister promised 3. We've had 2. And couple of appearances in the middle. So we have one more Friday blockbuster. I'm assuming it's going to be on a Friday. I don't know. One more left. What would you like?
I'm willing to bet there'll be more Fridays than just one more, Tamanna. But
at
genuinely,
least one more, because she promised at least 3 in all totally. So
it's good. Jokes apart, this is good. At least the intent and that is there.
Yes.
But I do think that besides monetary and fiscal stimulus and blaming the rest of the world for what we're going through, we have to understand that there are core issues both in sectors as well as in factor reforms that is within our control. And this is an opportunity. India will do well.
Yeah.
It will be great if India can do well because of its policies rather than despite the policies.
So see, these are strange times where even the state of the economy has got mixed up in the whole political discourse. And the fact is, if the economy is doing badly, it hurts everyone. So I agree to some extent with Bibek de Broglie when he says let's not go gloom and doom completely, but let's not close our eyes to what's happening. Let's not pretend that we are not in a bad shape. Let's think of what to do next. So let me come to you on that, Maithili. What would you like to see next? Assuming we're going to have one more Friday blockbuster or whenever it is. Clearly you're not too impressed with this consolidation announcement, but what more can we see?
Well, Tamanna, I'm not a believer in Friday blockbusters when it comes to economic policy. I think policies are not about blockbusting, are not about grandstanding. Policies are about doing nitty-gritty and getting down to the brass tacks. And that is where I feel, apart from whether you call it structural or cyclical, the fact is that structural reforms will not give you any immediate results. Take for instance GST. GST was a sorely needed structural reform, but we are still living through the pains of a GST reform. Fair enough, there are some warts, it's not a perfect reform, but even so, any such blockbuster reform, any such structural reform will entail some pain, and to the medium to almost long term, which is why we need both a short term stimulus as well as a longer term structural reform. And that is where I think the government is erring, because rather than grandstanding, what you need to do is that the government needs to start spending on the right kind of things. Even as you observe the fiscal deficit target, it's important that you alter or reorient your spending towards capital in spending. Infrastructure building, road building, railways, these are all areas where you can get much more bang for the buck. The fiscal multiplier, as economists call it, is much greater in the case of infrastructure project than in the case of anything else. So that is what the government should focus on getting brass tacks, get your act together, get the plumbing right, and then the rest will follow.
Okay, get the plumbing right. We've spoken, several times actually through the last few weeks of what the government could do, but we were still not looking at a 5% GDP figure. Jaggi, are you alarmed at all? I'm asking everyone this question. Do you think that we're at the bottom of that cycle? Because there are a lot of measures which will now take time to be implemented. Transmission of rate cuts by the RBI is one of them.
Yeah, I'm not alarmed, but I do think that we have 2 more quarters where we'll have difficult numbers before the revival really starts. We may have bottomed out, but the next 2 quarters will not show any robust revival.
Yeah.
So we think. I think we have to realize one thing. Throughout the term of this government, all policies have been largely deflationary. when you're going to focus on anti-corruption, tax compliance, and cleaning up the IBC code, GST, formalization of labor, every single thing, if you see, actually has a speed breaking effect on the economy. To make matters worse, we have a Reserve Bank which was completely cockeyed when it comes to inflation. There is no inflation in the economy, and they have been busy fighting inflation. So they have actually done a pro-cyclical high interest rate regime, which actually must have knocked at least 1% out of the thing. If demonetization knocked 0.5 to 1%, the Reserve Bank and the Monetary Policy Committee have done another 1% damage to the economy by maintaining 3 and 4% real interest rates. Even now, interest rates are too high for our kind of growth and our kind of inflation. I think both monetary and fiscal policy need to wake up.
Yeah.
Fiscal policy needs to take infrastructure out of the fiscal deficit roadmap thing. If you are spending only on infrastructure, it should be out of the fiscal deficit calculation. Only the spending that is purely driven by expenditure and consumption, government consumption, those are the things that you should track as far as fiscal policy is concerned in the short run. We need a fiscal policy holiday, and we need to bring in huge investments in infrastructure, real estate, whatever you need.
Okay. I just want to go into a bit more of detail of what numbers we've seen coming through. And let me come to R. Nagaraj on this. The manufacturing numbers show perhaps where the slump really has come from. The consumption figures, as was mentioned earlier on the panel, those are painful. Are those things which will take some time to fix? And remember, the GDP data also comes with its own lag. So do you agree with the Jaggi's assessment of perhaps another 2 quarters of pain?
Yeah. First of all, I would like to say that quarterly estimates in India are very poor.
Okay.
In fact, most of the quarterly numbers are based on the annual numbers and made up by rates and ratios. We do not mostly have primary data from the ground which give us the quarterly estimates. So I think we should use the quarterly numbers, but always with caution.
Okay.
However, after having said this, I would also say that the 5% number which has come out during the latest quarter seems closer to the reality, not based on the methodology, but the other numbers we have been getting. If you look at the numbers we have been getting about the automobile sales and the retrenchment which is happening in auto ancillary industries, even the consumer goods industries like Parleys or Britannia have said they have closed down a large number of their factories, which all point to the same thing, that manufacturing is not doing well. And therefore, I tend to believe that the 5% number is closer to the reality than many others may believe. So I think this is probably a good reflection of the ground reality. Then question is whether whether we have bottomed out. I do not know. I do not know whether if we have bottomed out. Maybe there's more pain, but I have no basis to argue either way. The question is, how do we get out of it?
Yeah.
I think the distinction between structural and cyclical, I think is incorrect. I think we have not been doing well for quite some time. In fact, to me, following Indian economy very closely, I would say it is similar to what we faced between 1997 and 2003. When there is a fairly steady decline in GDP growth rate and manufacturing growth rate. And if you recall, it was the Vajpayee government's very large scale investment program, road building program. If you call it was called the Golden Quadrilateral program.
Yes.
And the Pradhan Mantri Gram Sadak Yojana, which are both public investment programs, which really triggered a revival of the domestic economy. And I think this was later on continued by the later governments under different names, but essentially investment programs were revived.
But
if
do
you
we
recall,
have the fiscal
2003
space
to
for
2008 was the best period of.
Yes, but do we have the fiscal space for that? Maithili earlier suggested
see,
that
I would
let go of this 3.3 obsession. I'm just
I would say
paraphrasing
at this.
But do we have the space for that kind of spend?
may I complete my argument?
Yes, yes, sir. Yes, sir.
Hello?
Yes, sir.
Yeah, see, you must understand, see, at this juncture, I think fiscal deficit should not be the primary concern.
Okay.
The primary concern should be infrastructure and growth. Is lack of infrastructure more important than fiscal deficit? And if the fiscal deficit is created using domestic money for capital, creating capital assets, I don't think there is anything wrong with it. There is enough evidence. I mean, there is enough theory to back it up. Therefore, one must not be fiscally conservative at this juncture. When the inflation rate is very low, when the growth is very low, the idea should be to get growth going again, and that can be best done by what economists call the autonomous investment, and the autonomous investment always comes from the public sector. Okay, and that's what we did during the Vajpayee government, and I think we can again do it. There is no reason why we cannot do it, because there is a huge shortage of infrastructure, as most of the panelists have agreed. So I think we must think of reviving the economy. And
Okay,
again, the question
absolutely.
comes, there's an argument that we must increase consumption demand. I would argue that consumption demand of the poor are more important than increasing the consumption demand of the rich. Okay, and best way to increase consumption demand is in rural areas, and the best way is to regenerate our employment guarantee program, the MNREGA.
Okay.
I think we know there were leakages in that, but there are good examples of implementation of NREGA, which will put the money in the hands of the poorest and also create rural infrastructure.
Just,
and
yes.
And that's the best way to put money in the hands of the on the poorest. Okay, and this kind of regenerating rural economy by public investment is probably the best way to go about reviving the economy.
Okay, I just want some quick reactions to some of those key points that Dr. Nagaraj has made, and short ones, please, because I'm running out of time. But I want to get as many views as possible. Anant, revive Narega, bring back a huge infrastructure kind of spend, like the Golden Quadrilateral. Do you agree?
Investments into infrastructure, nobody can disagree. We can even go fiscally loose as far as investment in infrastructure is concerned.
Yeah.
My only concern on the fisc is we are not honest about our fisc. The quality and extent of a fiscal deficit is far worse than we've acknowledged. And therefore, we are operating in a vacuum as to how bad the fiscal situation really is, given low tax collections. Along with any kind of stimulus, including investments in infrastructure, which I completely agree with, I think structural reforms, both in sectors like financial services and power, in real estate, in construction, and factor reforms, land and labor reforms are important. If we get this right, what looks like a low number and a problem right now can become an opportunity. We can actually benefit from trade moving out of China into us, and we can actually grow at far higher rates than we are currently.
I want to thank all of you for joining us on the show this evening. We've had a setback of sorts with that 5% figure, but we've also seen the intention of moving forward. Let's hope for some heavy duty lifting to make sure that we get out of the slump quickly. Thank you for joining us this evening.